Okay, so flat on the market. Reliance is seeing a little bit of a pressure. And that's the big one that we have our eye on ahead of numbers. And right now that stock's almost dipped to the lows of the day. And Titan is seeing some selling as well so far into the session. That's the day's low on RIL. And Titan is struggling around the 950 mark, which ends up being a huge barrier for this stock. All right, but on that note, let's move forward and get to that promised conversation on what lies ahead for the capital goods and engineering space with respect to the Q3 outlook. Okay, before we get to that, actually, our movers and shakers segment also coming up. We have, a couple of stocks in focus. Ritu is joining in, I believe. Do we have Ritu with us? Ritu.
Okay, all right. I think, Surbhi, since it's earnings season, let's get straight to the earnings.
Right? Then to the earnings.
All right. So we have with us Renu Bed, Vice President, Research of IIFL Institutional Equities, who joins us in the studio to tell us what we can expect from the capital goods sector. Hey, Renu, thanks so much for joining in. Before we get to the expectations, is there, really demand on the ground? Are things coming back to normal? Are things looking good, basically?
Yes, definitely. If you look from a visibility perspective, companies today have a reasonably strong backlog, which provide visibility for the next 12-18 months.
Okay.
And in fact, the momentum that we have seen for the last couple of quarters, we see that momentum sustaining in terms of execution picking up.
Okay.
So domestic execution headwinds, which were there with respect to right-of-way issues and clearances on site payment, we have seen those easing out. So in fact, this quarter also, we expect most companies to show double-digit growth in revenues.
Okay.
Sector reporting close to about 15% growth in revenues coming through. And this is a combination of both infra-led spending from the government side, as well as a good mix of short-cycle orders coming through in the core industrial segment, which was the piece which was lagging in the last 1.5 years.
Okay, this is really interesting because everybody is really waiting for the capex cycle to turn and to see whether some of the industrial companies actually start performing well. So within that, can you sort of break it down? What part of industrial capex is working well, and therefore in terms of company performances, which are the main stocks that we should watch out for?
Yeah, so breaking down in terms of sector-wise performance, clearly within the industrial, the short-cycle businesses which derive demand from OPEX. So most of the companies which manufacture standard products, like you'll have motors, pumps, abrasives, those companies will be growing in double-digit terms.
Mm-hmm.
Also, the spending on digitalization and efficiency upgrade-related programs, which is happening on the corporate side, that is actually helping most of the multinational companies here, ABB, Siemens, to drive the digitalization-related revenues there. So the automation, robotics businesses will actually be growing between 20 to 30%.
Mm-hmm.
And we see those trends improving quarter on quarter for the last 2 to 3 quarters in a row now. So all these categories would be growing well. In fact, if we see, most companies are actually strengthening their network and base domestic in the market there. And these are all demand coming in from the base market itself. So not driven entirely by large orders or projects which you have in the pipeline.
Let's talk about the big boy, L&T. I think that's one of your top picks, right?
Yeah.
All right. L&T has seen some profit booking from the top. People are anticipating the buyback will come maybe sooner, but there seems to be a bit of a delay out there. But how is L&T placed? Is there a risk? I was reading a couple of reports a couple of days ago in terms of, order inflow will slow down because it's an election year. But that's all expected, right? How are you viewing the stock going ahead?
Yeah, exactly. I think the relative slowness in the order inflow in the second half was broadly expected.
Mm-hmm.
It was a part of the management guidance as well when they had given at the beginning of the year.
All right.
And clearly the strong growth that we saw of almost 43% in the first half was a reflection of front-ending of orders, plus better than expected inflows in terms of what they had. So this quarter, though I would say the announced orders have been close to 19,000 crores, one should not get too much swinged with respect to the actual announced orders. Always. The trends tend to be mixed at times. So we still expect the inflows to be steady, close to about 29,000 crores of core inflows for Larsen, including the services about 33,000 crores there. But clearly, in terms of numbers on a quarterly basis, they might look weak. But if you look at YTD inflows, they're still up by almost 9% for the stock. And I think more importantly, today, the order book visibility of the company is relatively strong. They have almost 18 months of visibility with them. And we are pretty confident that, at least for the next 1.5 years, they should be comfortable to grow double digit, as in between 12 to 15% in terms of revenue run rate for the company as a whole.
What target price do you have for L&T?
We have a target price of 1641, so which is about 22% upside from the current levels.
Okay.
So clearly, I believe the concerns with respect to the near-term inflows are overdone. It really does not impact the medium-term growth visibility of the stock, and the initiatives that the company is undertaking in terms of going asset light, divesting non-core assets, and buyback also has been in pipeline. It should be coming anytime this month. So all of these initiatives are targeted to create value for shareholders. It will help improve the core ROEs of the business.
Right.
And at the end of the day, when we look at the market in the current uncertain environment, especially when you have liquidity, currency, and commodity-related risk around, we've time and again seen that Larsen as a company has tended to do significantly better than most of the other mid-cap peers when it comes to managing this risk around.
Okay, so that's L&T. Let's talk about some interesting mid-caps as well, and throw in a word on some of the road companies. Which of the entire basket do you like the most? And again, you know, are there concerns about perhaps a slowdown in the order book growth, even for road contractors in the next couple of months?
What, as a house, we expect is definitely there has been some softness in terms of road construction awards. A lot of EPC projects which were targeted for this year, there seems to be some slippages. So close to 15-20% slippage is expected. And given the fact we're just about, we have this the last quarter and most of the projects could be awarded, practically after, I think, 4 to 6 weeks, one would not see too much of project awards in the road space as well. So there could be an interim slowdown happening through, but we don't believe it's a structural slowdown. Yeah. Most mid-cap companies in the road construction space today, they are struggling in terms of getting their HAM projects closure in time and get the appointed dates in place to execute them. So we believe this would be more of medium to short-term hiccups which they have with respect to the visibility today. But then structurally, the backlogs are strong and companies with good balance sheet should be able to deliver growth.
You wanted to tell us about your mid-cap picks as well. L&T is a pick from the large-cap space. The mid-caps, what do you like? Your 2-3 top picks?
Yeah, mid-caps, we like Thermax on the industrial side. Clearly a good quality name, a strong balance sheet. And with the backlog which they have today, they should be very comfortable doing close to 20-25% growth this financial year. In fact, next year as well, we expect about 15% growth. Okay. So on earnings CAGR perspective, close to 25% kind of earnings CAGR for the next 2 years. And more importantly, it's a good quality play that you see on the Cogent side, on CPP market.
We'll just come back to you. You know, we have Federal Bank that's come out with its set of numbers. The net profit number, that's bang in line with what our poll threw up. Gross NPAs as well, more or less actually flattish on a sequential basis. 3.14% compares with around 3.11%. So the initial couple of numbers that we have are, not looking bad. They look quite good actually, because you have the gross NPAs that are more or less stable, the profit number, and the net NPAs. There's some improvement in terms of asset quality. So mild improving is what we are seeing in terms of asset quality on a sequential basis. 3 numbers we have: net profit bang in line, gross NPAs more or less flattish, and in terms of net NPAs, there's a bit of an improvement out there. The NIs as well, as flat as can be. So Abhishek's poll in terms of the NIs as well as the net profit number, that's bang in line with what our poll dropped. So those are the initial details that we have. The stock is more or less flattish. We'll wait for some more details. But as of now, those are the numbers that we are working with. We'll wait by the,
provisions is what I have for you, Nigel. So we've got 190 crores they've done in terms of provisions this time around. And that's actually quite better sequentially. And this is despite the fact that, there was some confusion about Kerala floods and, whether there will have to be any additional provisions that, are still residual or left over for the quarter. But anyway, 190 crores is what they've done on provisions, as opposed to 288 crores. So that's a good performance on the quarter-on-quarter basis. The base quarter, I'm guessing, or the previous quarter might have had the bulk of the Kerala impact. And as of now, it seems to be an absolutely inline number with not too many problems, not too many hiccups. That's Federal Bank, more or less bang in line with estimates. But, Renu, just to come back, you were completing your point on mid-cap ideas. Thermax is one of them. Any others?
Cummins is one name which we are starting to like now, as in we have liked this name, but there were headwinds with respect to domestic competition, rising pressures. But recently we interacted with most supply chain partners, their competitors in India, as well as the GOEM partners. We get to understand that the HHP genset market is showing a strong pickup, both domestic as well as exports. This is very positive because margins on usually domestic HHP has been very strong. And exports has been a bit of an uncertain element in the performance. So we expect that this quarter could see some positive tailwinds and management could probably upgrade the guidance for a stronger note next year.
Okay. All right, Renu, we'll have to wrap it up on that note. Thanks very much for your take on the capital goods sector. But we now have Abhishek joining in with some more details on the Federal Bank numbers. Abhishek?
Well, if you look into Survey, the loan growth momentum has slowed down. It was at 25% in the previous quarter. And as per my calculation, it comes around to 23% if you do back of the envelope calculation. So loan growth momentum has slowed down. But the NII growth is pretty good on quarter. So it's at 1077 crores. That is an uptick of 13.5% compared to our pool of 1082 crores. But on asset quality front, it is a disappointment.
Okay, so asset quality seems to be a disappointment. Let's just go back and look at some of the additional numbers that we have. I don't have the absolute gross NPA figure.
The absolute gross NPA is at 3361 crores, and that compares to 3184 crores. That's an uptick of 6%. So typically for Federal Bank, the slippages have been between 400 to 500 crore over the last 4 quarters, barring one quarter where they saw 800 odd crores. So a good range would have been below 300 crores, but 400 to 500 crore is what typically the range has been for Federal Bank.
All right, so Abhishek, but the loan growth that we were working with was around 25%, right? And back of the envelope calculations as well, as you're indicating, I think on a sequential basis is up by around 4.5%, and on a year-on-year basis is up by around 25% or thereabouts. So that's more or less in line with what you were expecting, but you're saying that...
that's a bit of a slowdown. You know, people were expecting an uptake, but there is a slowdown. And if you look at the fact that their operating profit growth on a sequential basis is not strong, the operating profit sequentially has grown by just 1.5%. And despite the fact that gross NPA has increased, the provisions are down on a sequential basis. So that means there might be a downtick in terms of provision coverage ratio, which was at around 63.5% in the previous quarter. There might be a slight dip in provision coverage ratio on account of the provisions that have come down.
Okay, all right, Abhishek. Thanks for taking us through some of those details. So that is Federal Bank for you. On an absolute basis, there is a bit of an increase in NPAs, as Abhishek points out, and it seems the loan growth hasn't really kept pace with the market's expectations.